Hello, everybody. Ed Yardeni here. Thanks for joining us today. Well, we've got a really nice weather here in New York. Spring is here, and wouldn't you know it, with spring comes the gardener. So just as I'm starting my call, the gardener decided to come and do his work. So we may have some noise in the background, but we'll see. I hope not. Um, by the way, we'll start off with the usual chatter about the financial markets, the economy, and all that. But I don't know about you. I'm getting a little bit weary of the whole Trump tariff turmoil, the issues that have been kind of preoccupying the market here for the past several weeks. So I decided to invite a good friend of Yardeni Research, Jeff Moore, to join us. And Jeff is the CIO, the Chief Information Officer of Valmark Financial Group. And I thought we'd have a discussion about artificial intelligence. We've been so focusing on tariffs, we haven't had much time to have fun with artificial intelligence. So Jeff, I think will give us a lot of good insights, but I figured I'd spend about 10, 15 minutes doing our usual drill. Eric, by the way, I think you all know by now, Eric has taken a leave of absence. He's joining the Council of Economic Advisors. We wish him well, and we hope he can bring some stability and sanity to what's going on in Washington. But it's nice to know that I picked a fellow to join me. That now the government would like to have help them out, at least in the Council of Economic Advisors. Well, let's talk about things. Seems to me that hopefully things are calming down a little bit here. I think that's to a large extent because the Trump administration has moderated its tone, its tune about tariffs. Liberation Day was on April 2nd, and that was a shocker, and the market took a dive for a couple of days. Bond market also had a little bit of a hissy fit. And as a result of all that, on April 9th, the administration postponed Liberation Day for 90 days. If I counted the days right, that would mean July 1st is when that 90-day grace period, postponement period, will be over. And I presume that between now and then, we're going to hear about a lot of deals that have been done. I think the president's going to declare victory. Look, there's no way that a trade treaty can be negotiated and signed in a matter of 90 days. But letters of understanding, letters of agreement certainly can be signed in that period of time. The big issue is, of course, the ongoing trade war, the escalating trade war between the United States and China. And I think the administration has already blinked a couple of times in that regard. We're going to have a morning briefing for you tomorrow that kind of looks at the question of, how vulnerable is China to the U.S. And the conclusion we're kind of coming around to is they might be less prone to blink than we are for numerous reasons. One of them, of course, is China is an authoritarian state, and they can basically keep everybody in line, whereas we're not. We're a republic democracy, and everybody's got opinions here. We're awfully partisan, and the polls are unrelenting. The president's popularity polls diminished, especially when it comes to viewing the economy. Of course, these polls have become extraordinarily partisan. Democrats are all completely down on this administration, while the Republicans are still quite upbeat. But when you put them all together, you get some pretty depressing readings for polls, for consumer sentiment, and things like that. But again, they're very partisan, so it's not clear that we're getting a clear reading on what the average consumer is really objectively thinking about their current situation. Maybe asking anybody to think objectively in this environment is asking for too much. But we'll look at that and its impact on the economy in a minute. Meanwhile, it increasingly looks to us as though April 8th made the bottom in the correction that we've seen in the S&P 500. it came close to bear market territory, but it didn't get there, as we'll see in a minute. And now, last I looked, we were about 10% away from the all-time record high, which is pretty impressive, all things considered, especially all the panic and doom and gloom. And America's in decline. America's not exceptional. After all, the dollar is going to tank. All kinds of terrible things are going to happen. And meanwhile, the stock market's kind of indicating as though I think the market's starting to discount 2026. I think everybody knows that uh, Trump's tariff turmoil is probably going to have an impact on the economy over the rest of the year. It may actually, we know in the first quarter, there was a big surge in demand for imports as importers, wholesalers, retailers try to front run the tariffs. And that huge increase in imports arithmetically drives down the rate of growth of real GDP. And I think everybody's expecting real GDP to be up or minus about 0.5%. Consumers were also very weak in the first quarter, and when everything else fails, always blame the weather. But the weather was really pretty miserable in January and February, very, very cold months, and we did see a bounce back in March, but all in all, it still adds up to a weak consumer in the first quarter of the year. But the consumers are likely to make a big rebound here again as they come in. In the spring, there will be growth, as Chauncey Gardner once said. The spring is here. People feel better in the spring usually. They'll go shopping. But in addition to that, they'll be scrambling to buy whatever they can before prices go up as a result of tariffs. And a lot of that will impact consumer durable goods, particularly autos and appliances. And that can have a big impact and cause real GDP to increase 2.5 to 3% in the second quarter. Then the big question is what happens in the second half of the year. And we're still thinking that, everybody's thinking that it's about to be slower, especially if we have buying in advance in the second quarter. By the time you get to the third quarter, people will have bought whatever they could if it hasn't been cleaned out. And then things will be slow. Question is, will it be a recession? We don't think so. We think that the 90-day grace period, which will be over July 1st, by then this tariff issue will still be with us, but I think the administration will kind of want to get it behind them. They'll be focusing obviously on the tax cuts, which really aren't tax cuts. It's just an extension of the 2017 tax cuts that expire at the end of this year. But if we don't extend them, that'll be a big tax increase. But I think we can anticipate that the administration will have to focus on that quite a bit. And they're going to have to do what they can do to calm everybody down on the tariff issue, because it's certainly not going to be an issue that helps them as they start thinking about the midterms and as they start thinking about the economic impact of voters on the midterms. So I think the market knows all that. I think the market's kind of discounted all that. I think the market's starting to think about 2026, thinking that a lot of this will be behind us one way or the other, and that the focus will be on policies that make the economy grow. So maybe more emphasis on deregulation. I think even the Doge initiative will kind of peter out here. I mean, I haven't seen any really hard numbers, but I haven't seen anything like $1 trillion or $2 trillion in savings from the Doge effort. It looks like the numbers are more like $150 billion a year, which is real money. But it's actually somewhat encouraging to know that the government isn't ripping us off by more than $150 billion a year, or that there isn't a lot of waste in that regard. For a government with this kind of budget, $150 billion, it's good that we do this exercise every now and then, and we really see what we're paying for. But it doesn't look like that's going to be a miracle solution for the deficit. There's no miracle solution for the deficit other than Congress getting its act together and slowing the pace of outlays growth and increasing the pace of revenues growth. I mean, fixing the deficit is that easy. Of course, doing it politically is a whole nother ball of wax. Meanwhile, the bond market's kind of calmed down. It doesn't look like the bond vigilantes are acting up right now. The bond vigilantes did get the administration's attention there for a while, and I think that's one of the reasons they did postpone the tariffs. Trump said so, and then subsequently said that wasn't so. But hey, that's the noise coming out of Washington. Believe me, I hope he succeeds. I hope everything works out, because if he succeeds, America succeeds. But I hope he succeeds in the areas that, on balance, make this a better economy, make it a better society, and so on. But meanwhile, let's not get into all of that. That's entering a mud pit for sure. Let's have a look at some charts here. Again, I think April 8th did make the low in this correction. We've been using the word choppy to describe what we think the market is going to be doing. It looks pretty choppy to us. We even had to chop our forecast for the S&P 500 year end from 7,000 to 6,000. We did that back in March when all this tariff stuff was especially unnerving. I wouldn't mind having to raise my number back up over 6,000 to 7,000, but I don't think that's likely to happen. I think, we still have an optimistic outlook for earnings at $260 a share for S&P 500 this year and 300 next year. But you have to have a PE going back to 22 in order to get this market over 6,000. You'd have to have PE of 20 to get it to 6,000. So we're not going to push our luck here, and we're kind of going to say we're back in the bull market's back in the saddle again, in our opinion. But it's not going to be straight up. It's going to be choppy, and maybe by the second half of the year we'll start to see it heading up to more solidly to 6,000, and then we can start talking about new record highs next year. Well, again, let's look at the charts, and then let's bring my friend Jeff Moore in for a little discussion of something completely different than tariffs for a change. So let's see what we got here. So what we have here is the first quarter real GDP is going to be held down by this surge in imports. Some of that was gold imports, but there's still enough surging imports here to weaken real GDP growth. And then consumer spending was weak in the first quarter. Some attribute that to the collapse in consumer confidence. This is the Consumer Sentiment Index, which tends to be more partisan, I think, than the Consumer Confidence Index, but it's definitely about as depressed as they get here. And the Expectations Index looks like it's also matching previous major cyclical lows, and that's a leading indicator of the economy and consumers. But I've often observed when we Americans are happy, we spend money. When we're depressed, we spend even more money, as long as we aren't losing our jobs. And so far, the labor market looks like it's doing pretty well. Maybe it's going to remain intact. Maybe we'll see fewer hirings, but it doesn't look like we're seeing much in the way of layoffs. Meanwhile, consumers are depressed in the Consumer Sentiment Index because they think inflation is going to go to the moon. This is really quite an unusual reaction here. And again, I got to believe a lot of this is Democrats rather than Republicans. It's a very partisan poll. Democrats are extremely depressed, extremely convinced that this administration is going to bring back inflation big time, and not just over the next 12 months, but over the next 5 years. So that's unsettling for sure. So what are the consumers actually doing about it? They're going shopping. They're buying cars. We had this huge spike up in car sales during March. Again, some of that maybe because it was cold in January and February. The weather wasn't good. But now they're coming back. And then, of course, I would think that April, May, maybe even June, the car dealers will wind up having their inventory just completely cleaned out as people try to buy cars before prices go up as a result of tariffs. And by the way, we'll see the president still has got a 25% tariff on autos and auto parts. but he has said that he'll reconsider it. I hope he gets going and reconsiders it. Look, I said before, I can understand steel and aluminum, copper from a national defense perspective. We want to be able to make our own and not be dependent on foreigners. I'm not quite sure why autos are in there as a 25% tariff, other than Trump has this view that every car and every part of a car should be made in America. I don't quite get the logic of that. But meanwhile, consumers are shopping. As you can see, this blue line that is the weekly data on a year-over-year basis in Red Book retail sales, reasonably well correlated with the year-over-year percent change in retail sales, ex food services and autos. We're up 7% on a year-over-year basis. That's pretty good. Maybe they're buying things at the discount stores before the discount stores run out of stuff made in China. That's what this suggests. This is the Red Book data for discount stores, and you can see that's up 8.9%, whereas the department stores are up 2.4%. So the data so far shows consumer spending, and maybe some of that is buy in advance. Maybe some of that is Americans have jobs and they do what they do. They consume. And here's the job picture. Of course, initial claims. Maybe any day, any week now, this thing will suddenly spike up. But so far, it's not doing that at all. It's staying very calm here at levels that suggest that the unemployment rate is going to remain around 4%, 4.1, 4.2%. The jobs plentiful surveys so far suggest that jobs remain relatively plentiful. So again, labor market seems okay. For those worrying about stagflation, we've got more reason to worry about inflation than stagnation. This is the regional surveys on prices paid, and you can see they're picking up. And this is the prices received. So the prices paid are going up, so the prices received are going up as well. So there are mounting inflationary pressures. But the PCED, which comes out on Wednesday, is going to be something close to zero on a month-over-month basis. It's going to be should be a very low reading. So we're going to have a little bit of calm before the storm, if you will, where the inflation should likely pick up during the summer months. With regards to the stock market, this shows you MAGs, XMAGs, and SPY. So MAGs is the Magnificent Seven. It's an ETF that Roundhill puts out. It's equal weighted. It's rebalanced once a quarter. The XMAGs is exactly what it says. It's excluding the Magnificent Seven. It shows free float cap weighted. Again, it's also rebalanced once a quarter. And then we've got SPY as the S&P 500. And you can see that the XMAG has actually been pretty quiet. This is the 493. Hasn't been much of a change even during this correction phase here. The correction has been significant for the S&P 500, and most of that has been driven by the Magnificent Seven. So it's been a Magnificent Seven-led correction. They've actually been a bear market, but it didn't take too long. They're still magnificent. What can I tell you? You know, they got cheaper, and I think we're seeing some buying here. So this is kind of a handy-dandy chart that David Yardeni, who is related to me, put together for us. And this shows the percent change from February 19th, which was the peak in the S&P 500, to April 8th, which is what we think was the correction bottom. And then it shows from the correction bottom to the 25th. So you can see that the S&P 500 in the correction was down by almost 19%. You can see that the Magnificent Seven had a bear market, so that led the way down. And now, since then, that's been partially reversed to the point where the S&P 500 is down about 10% as of Friday's close. Then you can see that the Magnificent Seven have gotten cheaper. This is the PE ratio of the S&P 500 with and without the Magnificent Seven. They'd had a real drop from about 30 to about 22 in the forward PE of those stocks, which tend to be viewed obviously as growth stocks. So maybe that's bad enough. If we're not going to have a recession, just a slowdown in the markets thinking now towards 2026, maybe that's as bad as it gets. Obviously, if we have a bad recession, then having the S&P 500 get down to 19.2 isn't low enough. During the previous bear market, we got down to 15, and we did that without a recession. If you have a recession, obviously you could be lower than that, but that's not our story. It is, we haven't changed our probabilities, and that is 45%. That's pretty high. Not quite feeling quite as bad as 45%, but we're not ready to pull the trigger and reduce that number just yet. This is the Buffett ratio that's come down certainly for the S&P Magnificent Seven. Then meanwhile, the Magnificent Seven are still magnificent. They account for 28% of the market cap of the S&P 500. They account for 23% of earnings and 11.8% of revenues. And they have a very high profit margin, as you can see. And that includes Amazon, which does not have a high profit margin because of its retailing operations. Well, that's it. I want to get to Jeff. Jeff, you want to come on in?
Hey, good morning, Ed. Good morning. Good morning. How are you?
Looks like we got the same dress code, you know.
Yeah, exactly.
Well, Jeff and I worked in Akron, Ohio, for Oak Associates. Jim Olschlager was the head of Oak Associates, a wonderful, wonderful man. Certainly was great to us, and was a legend. He was kind of one of the original Cisco investors. Unfortunately, he overstayed his welcome in tech, but then he made a comeback. And Jeff and I did everything we could to help him make that comeback. So, anyways, Jeff was in the IT department, heading up IT at Oak Associates. Jeff, let's get right into it. You're at Valmark Financial Group. Do you guys use AI much? Do you see that as being a tool that's helpful, or is it just full of hallucinations and you're giving up on it?
Yeah, I'll give you some context, I think, for your audience, and maybe a little bit less on. We can definitely talk about some like how-tos, but I think just to give you a sense of the market, at least in the enterprise market,
Yeah, that'd
and
be
what
great.
people are thinking about it. And a lot of people in my role, like in a CI role, IT leadership roles, a lot of us, talking to my peers, we've been given mandates either from our boards, our CEOs, to do something with AI, right? They're saying things like, we're going to allocate special budget dollars to you. We want you to bring in outside consultants. So there's kind of this sense for a lot of us that we need to do something, but we're not necessarily clear what that something is exactly.
Right.
And this is going to get crystallized here in just a second. So Gartner Research, that's a big IT research company. A lot of
Yep.
like Fortune 500s, they all subscribe to Gartner. And I had my Gartner person call me, and he's like, we were talking a little bit about AI, and he said, "You're not going to believe this. This is like early April." He's like, "I hit my quota for the year, his sales quota." And that's because a lot of people in roles like this, they're being forced to spend money, or they need to spend money. They got to figure out, but they're not really quite sure what to do yet. So a lot of them have been putting investment in research services like Gartner because they don't really know what else to do with it, and they're not sure where to place their bets just yet. So I thought that was kind of an interesting backdrop.
So right now, the powers that be are saying, we're hearing all these things about AI. Investors are asking us about AI. On the conference calls, we got to mention AI and what, and we can't just mention it. We have to indicate what we're doing about it. So help us solve that problem, Jeff. And
Yeah.
and then guys like you say, well, that's a head scratcher. Why don't we turn to Gartner, say what do they recommend? It's sort of going to the consultants and saying, what do you guys think, and what should we be doing, and what are you hearing? It's kind of a gossip network, right? Tell us what's working.
It is a gossip network. I'll tell you what's working. So in terms of like what I think is really interesting, if you want to follow somebody online that I think has a really good perspective on AI and enterprise use cases, That's the CEO of Box.com. His name's Aaron Levy. He's been posting a lot lately, I think, on really practical use cases that companies can use. And I kind of put them in two big buckets. The first is what I called like unstructured data. So these are your documents, your PDFs, financial statements, all of that kind of stuff.
So
And
you put that's your data that you're putting into your LLM, your system, and it's all proprietary, so you know it's clean, and so it's not full of hallucinations. Did I get that right?
um, so, oh man, hallucinate. That's a whole separate. We can have that as a whole separate topic. But the ability to like put in a document and then extract key data points out of it. I'll tell you a
Okay.
simple story. We had we get lots of data feeds from vendors, and one of the vendors, for some reason, they decided to stop sending us a data feed, and they're like, "Here's a PDF instead." So someone in our commissions area, that's the area that pays out advisors, they were going to have to hand key like 33 pages of these like detailed line entries, and it was like, oh man, that's awful. So we ran it through AI, had it extract out the data, and it's much easier to verify the data than it is to hand key it. So I thought that's a really good use case. And we've been doing a few others like that, where it's like you've got some sort of data set, you want to do extraction, and you have some way to verify it, whether it's either human or whether it's some other data feed that you have that you can access and double check it. Because to your point, hallucinations. I literally had like 3 different people this weekend contact me about different hallucination stories. That is still alive, very much so. I think some of it's gotten better, but
Yeah.
any of this AI stuff, it needs to be validated and checked for sure.
Yeah. So is the hallucination something that is mostly attributable to using open source data where you just kind of take whatever's on the internet and let the thing go wild? Or can you, I mean, obviously that would cause hallucinations, but do you get hallucinations if you put in proprietary data? Like, for example, we've got a whole bunch of morning briefings. We've been writing them, for 10 years, 20 years. We got PDFs of them. So if we loaded those we are actually doing that. We're loading those PDFs, but I haven't had
Yeah,
enough experience yet with, okay, so I view AI for my purposes as a really fast search engine that also writes a summary of what I'm looking for and
yeah,
gives me the references. So,
yeah.
and that's useful. I don't know that it's, rocket science or dramatically changes our productivity, but it's very useful. Um,
I agree. I agree with you. I think that's another great use case because it can search those things. It does really well with that. And in most of the systems now, they're not only giving you the exact document that it referenced, it'll also provide the citation within the document. And I think that's really powerful.
yeah.
We've seen like in some insurance marketing type things where we'll get like a lots of different documents. One of our teams, something that would take them maybe 20 minutes to find, now they can find like in a minute or two. And the key being that citation, right? That you can go and you can see and you can validate what it's saying to make sure that it is true and it's correct
Yeah.
versus just asking a general question of the chat bot and then getting some hallucination.
Yeah, the story I've been telling is that AI really isn't revolutionary; it's evolutionary. It's evolutionary within the digital revolution. The idea being that the digital revolution since the mid '60s has been all about collecting as much data, processing as much data as cheaply as possible, as fast as possible. And we did that with IBM mainframes, and we did with digital equipment, mini computers, then PCs, then cloud. And it seems to me that AI, whether it works or doesn't, if everybody's kind of forced to kind of play with it, that's going to create more data and more data processing, and that should be a big positive for the cloud computing companies. And Google's latest earnings announcements basically kind of confirm that AI basically is just another tool to process data faster, more cheaply, which then gives us an incentive to collect even more data and process it. Does that make sense to you?
Yeah, that totally makes sense to me in terms of the flywheel because it is CPU intensive and it takes a lot of processing power to crunch through some of this. So it makes a lot of sense that um, Google would report that and others as well, right? That they're, I mean, I don't have the specific study, but from what I heard, in some cases, like some of the limits to the AI is just that they just don't have enough capacity online to get it out to everybody. And it's going to take time to bring on additional capacity for more people to order. So a simple example, we were doing a project where we're using some AI compute out of Amazon, and they give you a quota. You only get so much. So I was pretty lucky. We got a pretty, what I thought was good quota, but it's not unlimited that you can get. They're trying to kind of parse it out.
In other words, we already have capacity constraints. I mean, I mean, if we had a lot more capacity, it would get used.
I that's kind of the story that I'm hearing from some people. And the only firsthand experience I have is like the Amazon example where we're rolling out this new AI initiative. They give us our quota, and like that's as much as we can use for the month. Even if I want to pay more, like they're gonna constrain us
Yeah.
by a certain amount.
But based on your experience, would you agree that artificial intelligence is artificial and it's not intelligent? I mean, you have you seen anything in your work that suggests that, 2, 3 years from now, yeah, you and I are just going to be on the beach while AI does what we do?
Yeah, there's no way. There's no way. It's going to help. It's going to help. I mean, talk to any serious developer. You've heard lots of stories about AI replacing developers, and it's like if it's going to replace them, then why is OpenAI posting job postings for React developers at hundreds of thousands of dollars? Like their tool actually writes React code. So I also think even though the AI is good, at least today, and it's continually getting better, there's still something to be said for that person that has lots of experience and they can see the bigger picture and engineer and architect really well. I haven't seen as AI being able to do
Well,
that yet per
what
se.
about this hype that all code will be written by AI?
I,
That's just
I,
crazy.
I don't see it yet. I see it being helpful today.
Mhm.
I don't see it
Yeah.
fully replacing it. I
Yeah,
don't know.
it seems to me we're still going to need humans to double check and follow the sources. And I mean, it's
You
yeah.
know,
I mean, when this thing was first introduced, I was really excited that maybe I could sit on the beach and this thing would write our morning briefing. And then so I had to do some writing, and then I had to spend more time checking its errors and rewriting it than was worth the time.
yeah.
So much for that idea.
That's a great example. And I think what coders are saying is kind of the same thing. If they need to make an adjustment, whether the business rules change or there's some sort of like error, like it's called vibe coding, but you just like to ask it and have it to regenerate all of that code as you start to scale up, that gets a lot harder to do versus just having it help you write some functions, et cetera.
Well, I've got, usually we spend a few minutes doing some of the cues here that we get, some of the questions.
Okay.
Maybe there'll be some for you, some for me.
Okay.
Let's see. I'll go to the end here. Okay. Michael asks, when companies like Duolingo, Axon, and Tempest AI report colorful AI use cases, how skeptical should we be?
I hard to say unless I'd see the specifics. I'm not sure on the specifics of what Michael referenced, but yeah, I don't know. I'm definitely a one experiment's worth 1,000 expert opinions. Like I like to see it for myself and try it and get a
Yeah.
better sense versus relying on what somebody says. Because definitely people have incentive right now to hype their experiences. So I definitely am like I want
Okay.
to see it.
All right, here's another question for you from Bob. Recently saw a video clip of Eric Schmidt. That's exactly what was in my mind previously of Google, saying that the consensus is that within 6 years, computers AI will surpass human intelligence. What do you think about this?
Hmm. I don't know. I think we were trading notes over the weekend about Google mapping, right, and the ability to create maps and how it gets it 99% correct, but it's got some wacky ways of doing it that aren't necessarily sensical. I don't know. I'm definitely pro tech, pro AI, but I don't know about surpassing that. That's hard. I'll give you my simple example from the weekend too. So my niece came over and she for school she had to do this word search puzzle, right? It's like where they've got all the letters in columns and then they give you the words at the bottom. You have to circle and find them. I'm like, oh man, we should have AI do this. I'll just take a picture and have AI do it. And it went through and it explained like redrew the grid, it listed the letters, but it had no idea how to find the words in the phrase. It wasn't quite there. So,
Yeah, it's
but
not, yeah, it's not intelligent.
no, but I've
Yeah.
also seen some examples where I've had it like build a retirement calculator to predict when somebody can retire. And it does amazing. And it can do the math and understand inflation and the time value of money and all this. So I feel like it's a constant flux between like, this is the most amazing thing ever and completely disappointing.
I think
So
maybe the example you just gave is maybe if we really focus on specific tasks that we've tested it and it's really good at doing those tasks, then we can kind of rest easy that that's what it does really well,
yeah,
and we can trust it. I think there's a couple for me. I'll
yeah,
take just a couple more because I don't like to
yep.
overstay my welcome. William, Ed, you have mentioned gold imports several times over the last several weeks. Could you please explain what the gold imports were all about? I missed the memo. Um, well, apparently there was some front-running tariff issues with regards to gold in London versus New York. In other words, I really don't know. I can't explain it to you, but there's lots of stories out there that there was a big influx of bullion from overseas to the United States, and it's still a mystery what that's all about. But apparently, it's not going to be in the GDP accounts, or at least they'll make an accounting for it. If you go and look at the Federal Reserve Bank of Atlanta's estimate for real GDP, they show you a number with and without the gold imports. And last I looked, I think without including the gold imports, its real GDP would be down 2.2%. Without the gold imports, it would be down like 0.4%. So I'll take one more from Cagdis. At how likely is it that we see a recession like data in the summer and stock market still goes up? Alternatively, what type of recession, if any, would make you think we would take out the low of April 2nd in SPX? Thank you. I thought the low was okay, SPX. All right. Um, yeah, I think that we could see some recession data for June, July, August after we have a surge in spending. I think the market will. I think the market already knows that, and I think the market will be looking ahead. And to the extent that the tariff issue has been kind of put in the rear view mirror, and people are kind of back focusing on technology and productivity, consumer spending, which I think still remains relatively strong thanks to the baby boomers. I think that's a relevant scenario where we could have recessionary numbers and the market looks past it. And also, depending on what the inflation news does, the market may get excited about Fed easing. We're not in the Fed easing camp, but we're not dismissing the possibility that the market may start getting excited about that possibility. Well, with that, let me thank Jeff for joining me. Really appreciate it. And if you get some other insights along the way, give me a buzz, and we'll have you join again. And everybody have a good week. Thank you.
Thanks. Bye.